All right, we are live. Welcome, everybody. It is another week. It's amazingly the end of February. I'm, I don't know where the time is going, but it's out there, and we are chugging through. It's doing a whole bunch of tax returns. It's an interesting time of year because all the new people that we're seeing this year, 2024 is kind of whatever it is for the most part. There are some things we can do, but we're more limited than as we go through people's information, we say, oh, well, if we'd seen you a year ago, we could have done X, Y, and Z. And some of those numbers are large differences. But that's not what this show is about, except that it is. All right, so let's dive into it. So this is the $1 trillion show. And why is it called the $1 trillion show? Because that's the mission. We're going to save Americans $1 trillion worth of taxes. So, Doge is all in the headlines about cutting spending, which is great. I'm all for cutting spending, but let's keep it in our pockets to begin with, rather than waiting for the government to take your money and then do some craziness with it, and then maybe not spend it, and maybe send it back to you with a $5,000 check. Um, and we'll talk about the $5,000 check here in a minute. But before we get there, so how are we going to save $1 trillion? There's as much as I would love to do every American in the country's tax returns, it's not realistic. It's not going to happen. So what we have to do is we have to scale the tax saving strategies through technology, and that's going to be through streams like this. It's going to be through our courses. It's going to be through our tools that we're creating. All this kind of stuff. It's the technology that allows us to get this information out there, and that as people implement that, then uh, tax bills will reduce. We will save Americans all that money because you got to figure there's about 40 million. If we just focus on the business side, there's about 40 million small businesses in America, and a trillion divided by 40 million is what? Oh, 1E12 divided by 40E6 is $25,000. So if we saved every business or business owner $25,000 in taxes, that would get us to $1 trillion, which, to be honest, is not that hard. So, um, and if we take it easy on ourselves and we say, okay, we don't do it all in 1 year. Let's say we do it over 5 years. That'd just be $5,000 worth of tax savings for each one of those business owners over the course of 5 years, and then it's $1 trillion in our pockets, not in the government's pockets. So, so yeah, it's pretty significant, pretty doable as long as people are aware that there are things to do. I think the biggest problem with tax in general is that people just don't know that, hey, there are things you can do. A lot of people have this kind of general sense that, yeah, there's some loopholes that Wall Street fat cats, get that the average guy doesn't. It's like, well, the rules are there for everybody, so they can apply to a lot of people. So it's worth checking out. So that's the how of how we're going to get there. The who, this is me. I'm Neal. So I'm driving around in 2007 in my old Honda Accord, and my uh, I was so broke at the time that I was tutoring high school kids. So I'd go around to their houses and tutor them in like math and SAT and that kind of stuff. And I kept getting flat tires because I needed a new set of tires and I didn't have the money to pay for them. But I got a letter in the mail from the IRS, and it said I owed them over $1.3 million. So that was the beginning of my tax journey. And over the next several years, I got into the tax world and fixing my own problems, started helping other people fix their problems, and hooked up with a Wall Street tax attorney who kind of showed me the ropes. And here we are 15 years later, 16 years later, whatever it is, uh, you know, 50,000 tax returns later. So, it's a wild world out there, and it's been a long journey for creating Tax Sherpa, which is, our company now. And, people keep asking me about like why Sherpa, and And the answer is because, we're the guides. We're here to help our clients and help everybody throughout, America and, all American taxpayers across the world, save on their taxes through these technological solutions. So that's what it is that we do. One of the offerings that we have is a starter course, and I'll tell you, later on about how to get access to that. And basically, this takes you from nothing to having basic tax planning set up for yourself, and depending on if you have a day job kind of thing, or if you're a solopreneur, independent contractor, or small business owner. It's got two different tracks in the starter course. But before we get to all that, let's the fun part, because there's questions. There's always questions.
That's true.
Sarita and Fatma have loads of questions from clients that have come in over the last week or so, and but I have the answer to every question. We can cut it off right here. The answer is it depends.
It depends.
And it sounds trite, and it's like, oh, accountants always say that, lawyers always say that, and it's like, because it's true. That's why. So it's true because it depends on what we call facts and circumstances. What is true for you, it's not necessarily true for your neighbor, even though the monetary amounts might be different. And my favorite example is $100 shows up in your bank account. How much do you owe on tax on that? It's like, well, we have no idea, because it depends, right? Is it income? Is it earned income? Is it passive income? Is it income that carries some kind of credit with it? Is it a gift? Is it a loan payback? Is it all these different things? So all those different scenarios, just $100 showing up in your bank account, it all depends on the character of that transaction, and that's going to change dramatically what its tax impact is going to be. So with that, let's just jump in. What do we have going on this week as far as questions? And just by the way, I have no idea what the questions are, so we will find out together.
This is true. So we have someone that wrote in and asked, how can we make the tax system fairer for everyone?
Ooh. Okay, so it depends what you mean by fair.
Right, that's true.
Right. So this is actually a good thing about the $5,000 rebate that they're talking about. So remind me to circle back to the fair tax plan that was proposed like 25 years ago. Okay, so the $5,000 dividend that they're calling it. So Doge is out there, they're cutting, slashing, spending, all this kind of stuff, and they're floating this idea. Let's give everybody $5,000, as a dividend. And if you do the math, there's about 209 million individual human beings who file taxes every year. Some of those are joint, and it's one tax return, and some of them are single, some of them are head of household, some of them are married, filed separate. But let's just say 200 million people out there. And if every one of them got $5,000, then that would be $1 trillion worth of payouts. And you might ask yourself, it's like, well, if the purpose of Doge was to cut spending, then shouldn't we just keep everything more balanced? And that's a political argument to make. I don't know the answer to that, but is that fair? So one answer is everybody gets the same. That sounds fair. Another answer might be it's like, well, people don't pay in the same, so shouldn't it be kind of weighted to who pays what? If we have $1 trillion pot that we're dealing with, and somebody pays $1 million worth of taxes, and somebody pays $0 worth of taxes, shouldn't the $1 million person get a bigger rebate on the money that they put in? I don't know. And then that's just on the rebate side. On the payment side and on the rules side, it's what is fair. So everybody has the same rule book. That part is fair in that sense. There are special rules for special circumstances. So, like I was just looking at somebody who gets Social Security income, right? Social Security has a sliding scale of taxability, right? If your total income is lower, your Social Security is not taxable at all. as your income rises, it rises to potentially 85% taxable. And is that fair? It's all in the eye of the beholder. So, I think what most people think of as fair is simpler, not so much even. And there's definitely an argument for simplicity. So, when you ask like why are the taxes this way or that way instead of this other thing, and the only answer is because Congress says so. That's
Mm, true.
there's no like grand principle of taxation or anything like that. It's just they passed the law, that's how it is. And over the 100+ years that we've had an income tax, it's changed constantly, over those years. And so we end up with more and more like weird edge cases and special rules for this industry, special credits for that industry. So it's an ever growing complexity. So there's definitely an argument there to be made for let's get rid of a lot of that and we'll just treat things similarly. But even there, um, there's different basic categories. There's earned income, there's passive income, there's capital gains income, and all of these are treated differently for tax purposes. Um, and then you know because it's a political process, it's never going to be able to escape that. So even if you like every 10 years there's like a new tax reform act. um, Even if you have a reform that makes things simpler or easier or fairer or whatever, as the years go by, the congressional process continues to happen, so it's going to get re-complexified, and that's just how it is. So I don't see any realistic chance for that to change. Trump talks about, oh, we're just going to raise tariffs. It's like there's not enough. You'd have to have like 200% tariffs in order to get rid of the whole income tax system, and it's just not feasible, really. So yeah, that's my meandering answer for creating fairness. Things could be simplified, but it'll just be recomplexified,
That's true.
shortly after that. Now there is this concept of the fair tax, which has been around for, like I said, 20, 25 years. It gets reintroduced in Congress every year and never goes anywhere. And basically what that is saying, okay, instead of paying an income tax, we do a national level sales tax, retail sales tax. So if one business sells to another business, that's not a taxable event. But if a consumer buys a product or a service that finalizes the supply chain, then that is a taxable event. And the way they calculated it, and this was like, again, 20, 25 years ago, so I'm not sure this math still holds true. But what they did was they said, okay, if something currently costs $100, it would under the new system it would cost 77, and it would have $23 worth of sales tax on top of that. So and then you would get rid of income taxes entirely. And for a while, I was actually a supporter of this idea, but it's never gone anywhere, and it had its own complications. So um, people talk about having a progressive tax system, and what that means is that people who earn less pay less, not in just absolute dollars, but pay less in percentage than people who earn more. So the more you make, the more percentage you pay in tax, and that's our current system. So under the fair tax proposal, what they would do is they would give every family a monthly check for the amount of tax they would spend on the basic cost of living. And so if a family of four spends, I don't know, $3,000 on food and shelter and whatever, they would get a tax. They called a prebate payment for whatever the tax on that amount would be. So already there's like complications. It's like, and then you can immediately start to think of ways to get around stuff. It's like, well, if it's only consumer purchases that are taxable, then well, why don't I just open my own business and have business to business transactions? So immediately you run into complications, and that's just how it's going to be in a nation as big as ours, with as much stuff going on as ours. Then there is no long-term solution for creating a simpler or fairer solution because it will just get undone by future legislation. I wish I had a more optimistic view for that, but kind of is what it is. And we're going to get another tax bill supposedly here in the next couple months. It doesn't look like it's happening within the next. Originally they were saying by April. That seems unlikely at this point, given their current status of negotiations. But sometime this year we're expecting something, and it will have its own new set of complications. So, so that's what
Something
we
to
got
watch
there.
out for.
Something to watch out for. Yeah.
Yeah. Looks like we have a question about the IRS layoffs.
Yeah.
Someone wrote and said, given the recent IRS layoffs, what steps can taxpayers take to ensure their filings are processed effectively and
It's a great
refunds are
question.
received promptly?
Yes. Yes. So here's what you do. You must file electronically. You must be complete in that, what you want to avoid is having any human being having to review anything on your tax return. Because if that happens, and now there's a whole lot fewer people working for the IRS, then it's going to slow things down. Serena and I were talking to somebody earlier today. We did an amendment for 2022. We sent it in back in November, and we're still waiting. And now we're really waiting, right? So I just told him, it's like, hey, no idea how long it's going to take, but it's processing. So yeah, you want to have a fully complete file. So you didn't forget anything. You didn't leave out anything. For years and years, Obamacare stuff was always the bane of our existence. People would forget that they have this other form coming and it impacts their taxes. Um, so it's a constant thing. So make sure your filing is complete. Make sure everything is done via like direct deposit or direct withdrawal, and make sure you file electronically, and just make it as simple as possible on the computer systems to process your tax return. So yeah, that's the basic idea. It's kind of hard to get into specifics without because we're talking
Right,
generalities here.
right. Because everybody's situation is different, right?
Right, exactly, because it depends. But
It depends, yeah.
but yeah, so the biggest thing is the matching. So when a company issues a W-2 or 1099 or 1098 or 1095 or any of these forms, a copy goes to the recipient and a copy goes to the IRS. Make sure, and I know I'm repeating myself, but make sure that everything the IRS gets a copy of is on your tax return somewhere, so that there's no mismatches. And if you do that, then things have been fine. So like, well, on the day that the IRS opened this year, which I think was I think it was a month ago today. I think it was January 25th. So I submitted my tax return because I keep my personal tax situation very simple. And I submitted, and 3 weeks later, I got my refund, and it went through just fine. It processed fine. Refund went fine. So it was all good. Um, and if you can stay in that lane, then you'll be good to go. It's just anything requiring a person, timeline is out the window. So try to avoid that.
Understood. And looks like we have a crypto question.
Yep.
A client wants to know what are the tax considerations for individuals engaging in crypto transactions and how can they ensure compliance with IRS guidelines?
Yeah. So it depends on what you're doing. So, crypto is a thorny beast. So
That's true.
so if you are just buying and selling crypto, like you would be trading a stock or a bond or something, then it's not that bad because it follows the same kind of rules. One exception is that there's no wash sale limitation for crypto, which can be really powerful. Um, but if you are doing anything else, so if you are doing DeFi and you're in liquidity pools, or you're bridging tokens across different blockchains, or you're playing crypto games, or you're staking, and all these kinds of things. All these introduce complications. So fundamentally, you have to pick a method. And by method, I mean like last in, first out, highest in, first out. So it's like because things are fungible, one token is the same as another in most cases. Um, then if I sell one Bitcoin, let's say, and I had three, well, which one did I sell? I don't know. There's just a balance, right? So you have to pick a method to track the tokens within your wallets, and you have to be consistent with that. So that's thing number one. Thing number two is that if you are doing any of these more complicated things that don't really have an analog um, in traditional finance, then you have to track things as best as you are able. There are software platforms that claim that they can reconstruct your crypto transactions. I have yet to see one that can do it correctly with complicated things going on. So then it brings in the question of the fact that there is no tax law regarding cryptocurrency. What happened back in 2013 was the IRS just stuck a flag in the sand and said, hey, we're treating this as property, go from there. And it's like most people have kind of gone along with that. And so, for example, several years later, the IRS published an FAQ on like what happens in this situation, what happens in that situation. And you can read through that and kind of interpret, and it's all consistent uh, with cryptocurrency being treated as property. So, for example, if you get an airdrop token, so you hold token X because you hold token X on a certain date, other project gives you token Y. What is that token Y? Well, according to the IRS, it is income at that point, and it's ordinary income. So, in that kind of situation, you have to pick up the value of the token that you received on the day you receive it as ordinary income, and then whatever that ordinary income amount is creates the cost basis for a future capital gain event. So if I receive the token January 1st, there's a certain for $100, let's say, and then I sell it on February 1st for $200. Now I have 100 of ordinary income, and then I have 100 of capital gain. So, it gets complicated. The IRS also says that any exchange from one token to another is a taxable event. So if I have token X and I trade it for token Y, that's a sale of token X and creates a new cost basis for token Y, but that I might have a gain, I might not, might have a loss on token X in that transaction. Similarly, if you bridge a token, so I have token X on Ethereum. I hand it over to a bridging service, and I get token X on Arbitrum or some other blockchain. Is that the same thing? Well, probably not. So, you're going to have a loss and then a gain on the other side. Same thing with liquidity pools. You give away tokens for nothing, and you receive a valueless LP token that has no market value and is worth zero. So basically, you took 100% loss on that transaction. So you get into all kinds of weird stuff. Now, that's just level one, right? Level two gets into the fact that there has been lawsuits about like staking rewards. For example, there was a case out of the Tennessee district, I think it was, where a couple they were staking, I don't know, some coin, and they were getting rewards. And initially, they filed a tax return and they declared those rewards as income, and that went through. And then later on, they said, "Wait a second, that's not really income. It's not income until we sell those tokens that we received." Because their analogy was, if you are a bakery and you bake a cake, you don't pay tax when the cake is baked. You pay tax when the cake is sold. So the ingredients that come together to form the cake are kind of irrelevant. It's just, when I sell something to a customer, that's when a taxable event happens. And so they amended their tax return. The IRS approved the amendment, which was interesting. And then they decided to pursue law to create tax precedent. And it got hung up in court and kind of never went anywhere, at least last time I looked. Um, Level three of that whole thing is that we are now in a post-Chevron world. So meaning that there is no deference given to agencies without law. So the fact that the IRS said in 2013, "Hey, it's going to be this way," you know, in a post-Chevron world, that's just their opinion, right? It's not a binding anything because there is no tax law associated with cryptocurrencies. So fundamentally, do your best. You are required as a U.S. taxpayer to declare all worldwide income. So like the question is, what is income, right, in these cases? And it depends a lot on the specific situation of what it is that you're dealing with. And that's not even getting into NFTs and all this kind of stuff. So I mean, it's complicated, and there is no clear answer at the moment. But do your best, be consistent, and that'll keep you, somewhat in the clear.
That's because it was a general question, right?
Yeah.
So it depends
Mhm.
for this question too.
It always depends.
Yeah, it always depends. Looks like we have a Augusta rule question.
Okay.
Someone wants to know, how does the Augusta rule work and how can I qualify for it?
Yeah. So this is a fun one. So the Augusta rule is called Augusta because it comes from Augusta, Georgia. So the lore of the rule is that a bunch of rich guys who lived around the golf course, the Masters, or Augusta National Golf Course, where they hold the Masters for golf. A bunch of rich guys who live around the golf course wanted to rent out their houses during the tournaments and not pay taxes on that rental. So in 1976, there was another tax reform act, and I've actually looked at the legislative history because they keep notes on things of like the revisions of the law. And this language just appears one day, which is kind of hilarious. So I don't know who slipped it in there, but basically, in 1976, Section 280 AG was created. And basically, what that says is that if you rent out your primary dwelling for 14 days or less during the course of the year, the income from that is excludable from your taxable income. And similarly, the other side of that is you can't take any deductions against that because I think that's fair. If you don't have to pay tax on the income, you don't get the expenses. So it's just a wash, basically. And so that is the core of the Augusta strategy, or sometimes you'll hear it as the master's rule or something like that. Um, so basically, you can rent out your house to anybody for up to 14 days during the course of the year and not pay taxes on it. So what we've done is we've elevated it to a higher level, and we created the summit strategy sessions. Because the thing that people screw up about it is that they don't know what numbers to pick. So we'll guide them through the market research on how to find the um, comps in their area as far as listings and things, and to come up with a real number based on real listings as far as um, how much to charge for a day's rental or a week's rental or whatever it is. And then where it really shines is, I mean, you could rent it to anybody. So you could list your house on Airbnb, and as long as you rent it out for less than 15 days, so 14 days or less over the course of a year, you don't have to pay any tax on that income. It's excludable from your taxable income. Um, but if you also are a small business owner, then if you do it right, you can rent it to your business. And the problem with that, though, the places where people screwed up is they don't have an actual business purpose, which gets under Section 162, and they they don't know how to run that kind of thing. So in the summit strategy sessions, what we do is we create management meetings, and we will actually show you how to walk through operating your business as a manager or an owner rather than a doer. So um, I don't know. I've only got 30 minutes, but basically, if you want to know the difference, go read the E Myth by Michael Gerber. And he talks about the E Myth is the entrepreneurial myth, where people who go into business for themselves typically do it because they're good at a thing, which is great. You're a great handyman, so you open a handyman business. Um, but just because you're good at doing the thing does not mean you're good at running a business that provides that service. So you want to make sure that at least once a month. So, if you do once a month, that's obviously 12. Um, at least once a month, you are sitting down and operating as an owner or manager rather than just the technician who's out there doing the work. And what the Summit Strategy session does is it guides you through that and shows you how to look at your books. Well, one, that you have to have books. Two, how to look at your books on different time frame comparisons, and then what to look for as far as your business condition, and starts to get you, you know, operating as that manager level. And so, and it creates, minutes along with it so that, you have all your documentary backup for the fact that you had your meeting, and basically just solves all those problems that people screw up with just a plain old Augusta rule. So that's kind of the basics of how it works. And it's one of those things where you know uh, it's not going to be a huge mover. It could be several $1,000s potentially, but where it really shines is that because it gets you running your business better, then over time, as you do this month over month over month over month, then your business will grow and grow and grow and grow. Whereas your competitors aren't doing this, and I can tell you they're not because I've seen all their financials. And you're gonna beat them out in the market. You'll end up making more money, and in the end, you will actually end up paying more in tax because your income's going to be higher. So it's kind of a tax code that creates an investment into your business so that you can have a bigger business later on. Yeah, but you got to do it right and make sure that you follow all the rules and make sure you have business purpose and all this kind of stuff. So that's what we coach people with.
Yep. So you can do it, just gotta do it right, Neil?
Yep. That's the same thing with all the tax stuff. So, every
That's true.
year the IRS comes out with their dirty dozen list. And that doesn't mean those 12 things on their dirty dozen list are bad. It just means that people abuse them and don't do them right. And because there's a history of people abusing them, then they have closer scrutiny. But it doesn't make them illegitimate in any way. It just makes sure you just got to follow the rules. So like one of the big ones over the last couple of years has been conservation easements. So you have a piece of property, you put it into a conservation easement, which means it can't be developed forever, and you get effectively you get a write-off for the market value difference. And people were selling these things. I mean, they still are. I mean, there's promoters out there who will sell you a conservation easement syndication where you buy in a chunk and basically the tax write-off that you get is greater than the amount that you put in, so you're net ahead. Okay, fine. Except the problem is sometimes the property doesn't exist, or sometimes the property does exist, and the values that they're putting as far as the worth of the property and the worth of the tax write-off is not reasonable. It's not supported by local markets. So it's but if you have a piece of property and you put it into a conservation easement and you value it appropriately, then it's perfectly fine. It's just you have a higher scrutiny on it because of these other bozos who are abusing the tax code provision. So you know you just gotta follow the rules and you'll be fine.
And then you can use Augusta.
Yeah.
Um, so we have a QBI question.
Uh-huh.
Someone wants to know, how do QBI, qualified business income deductions, work for an S Corp?
Yeah, so QBI was one of these things that was invented back in 2017 with the Tax Cut and Jobs Act. And this is the qualified business income deduction. What makes it qualified is that it's a trader business that's not a specified service. So like tax professionals are a specified service and don't qualify for QBI. But basically there's a short list of what are called SSTB, specified service trader business. If you're not on that list, then you're qualified. And if you have a business, the business income is going to be a pass through. So it's going to be a Schedule C, a Schedule F, a Schedule E, or it's going to be an 1120S, which is an S corp, or a 1065, which is a partnership. So it's one of those. Then it has pass through income, which comes home to the owners. So if you own 50% of an S corporation, the profit from that S corporation, 50% of it's going to go to you. And you have to include it with all your other income that year on your individual tax return. And the qualified business income deduction gives you up to a 20% break on that income, meaning that if you have $100,000 of pass-through income coming to you, then you might get $20,000 of deduction against that 100. So you're left with 80, and then you're taxed on the 80. So it can be, depending on the numbers involved, it can be a really powerful strategy. So so one, you have to have a qualified business. Two, that there are different thresholds depending on your filing status. So just off the top of my head, it's like 190, 380, something like that. It changes a little bit every year. But if you're single, head of household, married filing separate, you get the lower one. If you're married filing joint, you get the higher one. If you're under that threshold, then you get the 20% break. So if you're on 100,000, 20% is 20,000, you get that deduction. If you're above that, though, then it becomes tested. So it becomes tested against 20% of the income or 50% of the wages paid by that entity or 2.5% of the assets owned by that entity. So if it's like a real estate company or a manufacturing company that's very asset heavy, most people end up with the 50% wage test. So they compare the assets to the wages. Whichever one of those is higher is then compared against the 20% of the income, and whichever one of those is lower is what you get. There are some additional modifications there with itemized deductions and capital gains, but that's kind of the basics. So it is a very complicated deduction. It takes a lot of planning to make sure that you maximize that as well as possible. And it's going to depend on your business structure. But yeah, it took me like 4 years to really build a worksheet that really worked as far as the planning side for qualified business income deductions in order to make sure that's as efficient as possible. But yeah, it's super powerful. 20% may not sound like a lot, but especially if you're in higher brackets, it's enormous.
I was gonna say that too.
Yeah. So if you're in a 37% bracket, then 37% of 20% is like 6 or 7% like net cash in your pocket. So that's a lot.
Just got to do it right.
Just got to do it right. It takes a lot of work, to be honest.
Right.
And you have to continually update it throughout the year to make sure that you're on track for maximizing that.
Understood. And it looks like we have someone that wrote in about prepaying expenses. So someone said, can I prepay expenses at the end of the year to lower my taxable income?
Yeah, I mean, if you're cash basis, yeah, you can make that work. If you're accrual, then maybe not. So most businesses are cash businesses. So you have to have something to hang your hat on when it comes to prepayments. So yes, it can be done. You got to be careful that you actually have something on the other side, meaning that you can't just prepay just random things that don't make sense. That I've seen all kinds of stuff, right? So it's
Yeah, that's true.
so you got to make sure that what you're prepaying is part of your actual business, and yeah, as long as you follow through on that, and it's part of your normal business, then yeah, that works, and your cash basis.
Alrighty. Looks like we have a solo 401k question.
Okay.
Someone wants to know, can I take both a solo and a SEP IRA deduction as a business owner?
Solo and SEP, no. I mean, oh, sorry. So let me rephrase that. Yes, but they share a limit. So you don't get extra, if that makes sense. So like right now, I think this year's limit is 69.5 or 70. I'm trying to remember the 2020. I'm all in 2024 mode, which is 69,000. But I think the 2025 number is 69.5. So you can do both, but you're limited as far as contributions as the total. So that's fine. There are some employees in like school systems and stuff. They'll have like a 403B and a 457. Now, 457 has its own contribution limit, so it's separate from the 403B. But with SEP and 401k, they're going to share. Um, so typically, solo 401k is going to be more efficient because you get to contribute from both sides, as an employee and as an employer. Whereas a SEP, you're only limited. As a SEP, you're limited as an employer to 25% of the wage. So um, generally, you can get more contribution for lower wage as a solo 401k as opposed to a SEP.
Alrighty, understood.
Yep.
Uh, so it looks like we have an audit question here.
Okay.
Someone wants to know, what are my options if I'm audited and disagree with the IRS findings?
Yeah, you can fight in court basically.
Yeah, I was going to say that too.
So yeah, and audits are a very odd topic right now because we're hearing from people that across tax Twitter and stuff that says, hey, my audit got delayed because the guy who was
Wow.
auditing me got fired. So it's a wild time for again anything requiring a human being. So the general process is you get a letter in the mail, which is called a request for explanation, and they'll have listed some items on your tax return and say, "Hey, give us further explanation of this thing," and you have to respond with whatever documentation you have around that particular item, or it might be multiple items. Just kind of depends. And so you send that back, and you might get a phone call. How much back and forth there is depends on the complexity of the audit. One guy's been dealing with the same audit for like 4 years, which is
Wow.
crazy. But most things are resolved, in a couple months. And the and at the end of it, the IRS makes a determination. So okay, so if you don't like the determination, then you can appeal and basically, go through the beginning stages of the court proceedings. Now, I will tell you, the vast majority of people do not do that. So it's expensive. Most people lose when they do that. Just you're going to tax court. It's a special court that is separate from regular court. So, by the time it gets to that point, the IRS has a very strong winning record. So,
Wow.
unless there's something egregious, it's usually not worth the time and effort and money. But yeah, it can be done. There are other cases where it's like, let's say you end up with somebody like an auditor who is just unprofessional and is just blatantly ignoring the law and things like that. There is the Taxpayer Advocate Service, which is your kind of like internal watchdog organization for the
Yeah.
IRS. Debatable how accessible they are. They're really, really slow as far as getting back to people and looking at their cases and things like that. But it could work. Um, but yeah, that's basically it. But, at that point, you're beginning some kind of legal process.
Alrighty. Understood. Uh, Looks like we have a question about tax laws, estate tax laws.
Okay.
Someone wants to know, how might someone propose changes to the state tax laws impact the high net worth individuals, and what proactive measures should be considered?
Well, there's a whole industry of
Yeah.
proactive measures, so that's what your estate planners will do.
Yeah.
Um, so yeah, as far as the law goes, it's part of all the other tax law, so it's the same process. So right now, they're talking about so in the Tax Cut and Jobs Act, they doubled the lifetime exclusion amount. So the way the exclusion works is that during your lifetime, you can give away a certain amount in gifts, and then when you pass away, your estate is going to have a certain value, and the sum of those are subject to a lifetime exclusion. If you're under the lifetime exclusion, no tax is due on your estate. If you're above the lifetime exclusion amount, then the amount above is subject to tax. So, and in the Tax Cut and Jobs Act, they basically doubled the lifetime exclusion. But Tax Cut and Jobs Act is ending in 2026. So Part of the negotiation that's going on right now is to make that doubling of the exclusion permanent. And so that's pretty likely to pass. And so, if you're a married couple, the one, usually the husband dies first, leaves assets to the wife, and then the wife passes, leaves stuff to the kids. That's the typical
Oh,
order of
sad.
things. Well, is what it is. Um, so, with a married couple, you get two people, and so basically it's like 20, I'm just gonna round numbers, 20 uh 25 million worth of exclusion. So if you're above that, or if you have assets above that, then you talk to the estate planners and they'll set you up with trusts. They'll set you up with donations to charitable entities. There's a bunch of strategies um, for divesting yourself before you pass away in order to reduce your estate to underneath the exclusion threshold. Now, it's worth noting that most states follow the federal, but some don't. So, like New Jersey has a much lower estate exclusion. I think it's 2 million in New Jersey, and a couple other states have similar kind of like different numbers from the federal. So, definitely consult with an estate planning attorney in your area, both in the area that you live and in the area that your assets are in, if there's a difference. So, estate planning can get pretty complex depending on what you have going on. But and it also encompasses other things beyond just the financial impact, but like who's gonna take care of you if you're an invalid, you can't make decisions for yourself, or you're in an accident and you're comatose, and who has the decision-making authority in all those things. And then, when you do pass away, who's going to be the executor and who's going to do this and who's going to do that. So, the estate planners, they encompass all those different things into a plan, and make it appropriate for your situation. So, but yes, as far as the law goes, it's just along with all other tax laws, same exact thing.
Understood. Looks like we have another question about agreeing on minimum tax rate. Someone wants to know what are the challenges and benefits of countries agreeing on a minimum tax rate to prevent tax competition?
Yeah, so this is what they call global harmonization.
Right, right.
Um, basically, it's how do I want to say this? It's a conspiracy. So, this became a hot topic, especially with Ireland. So Ireland made themselves into a tax haven for international companies, and there were a bunch of different strategies around having a company located in Ireland that then leased intellectual property back and forth between other jurisdictions. And so a lot of big tech companies took advantage of this. And Ireland was happy with it, and everybody else was not happy with it. So basically countries started getting together and say, okay, if we keep going down this road, we're going to end up with nobody collecting any tax because we're going to compete with each other for business, and it's just going to be a race to the bottom. So let's all agree to not go below a certain bottom line, which is, it's a cartel and it's a conspiracy. So that is kind of how what the current situation is. There are definitely exceptions to it, but the major players have kind of all gotten on board with each other. So, the double Irish, for example, is kind of dead and gone. Um, but even beyond that, there's there's banking information. So um, I forget what it was, but basically, if a U.S. taxpayer has ownership or signature authority on a foreign bank account and the total amongst all foreign accounts is greater than $10,000, then there's an FBAR requirement, which is a foreign bank account reporting. I think that's what it stands for. So every year you got to tell the government, the Department of Justice, where your money is if you have foreign accounts. And all the foreign financial institutions know this, and so a lot of them really just stop doing business with Americans, just because it's too much of a hassle. So, but there are still some that do, and you know, there's no tax or anything associated with it. They just want to know where your stuff is. right? But it gives
They
them
want to
an
be
in.
nosy.
They just want to be nosy because it gives them an in if there is tax evasion or something like that. So that is that's kind of the state of things. So effectively, any any decent sized country is cooperating with the U.S. To report financial institution ownership kind of information, as well as kind of you know I rub your back, you rub mine kind of thing as far as the tax side of things on the corporate thing. There are exceptions to that. Like I think the Cook Islands is still willing to tell everybody to go pound sand. Uh, but it's few and far between when it comes to that kind of stuff. So bottom line is, they want to make sure to as high a degree as possible that there's no escape from the taxation system. So that's kind of where we are.
Understood. We have 2 more minutes, so I guess we're good for 2 more questions, Neil, or
Sure,
no?
let's give it a shot.
Okay. So someone wants to know, what are the key tax deadlines for small businesses?
Hmm. Okay, so starting on January 1st, January 15th, fourth quarter personal payments are due, or personal estimates are due. Um, and that's going to be true. So some states will also assess taxes at the pass-through level. Um, and in most cases, that will also be January 15th. January 31st, W-2s, 941s, 1099s, all that stuff is due to go out. Then we fast forward to March 15th. March 15th is going to be the due date for S corporations and partnerships, that kind of stuff. That's the original due date anyway. So most entities go on a 6-month extension. April 15th, actually, sorry. So March 15th, March 31st. No, sorry, that's backwards. April 15th, 1040s and 1120s are due. April 30th, that's when Q1 payroll submissions are due. So your first quarter 941s and things like that. Then we get into June 30th. If this is kind of a not too common, but if you're out of the country, then that's your 1040 due date. Then into July 31st, the Q2 payroll stuff is due. And then we get to September 15th is going to be, oh, sorry. Also, June 30th is second quarter estimates are due. Where was I? So that's June, July, September 15th. Third quarter estimates are due. Also, your 6-month extensions for partnerships and S corporations are up, and so they're due by that point. September, no, so that's September 15th. October 15th, your 6-month extensions on 1120s and 1040s are due. Now, when you extend 1120s and 1040s, those are actually going to owe tax, or potentially, right? So the tax payment is due way back in April, even if you do an extension. The extension is an extension to file paperwork. It is not an extension to pay. So if you wait longer, they will charge you, even if you file an extension, they'll charge you additional interest and things. So just keep that in mind. October 31st, then we are into third quarter payroll stuff. And then December 15th, if you're a C corporation, an 1120 filer, then that's fourth quarter estimate is due. So unlike personal, where the fourth quarter is due after the end of the year, and if you're C corp, it's due before the end of the year. And yeah, then that rolls into January of next year, and then we start all over again. So those are the key dates with all that. So for most people, if they're a small business owner, it's going to be quarterly filings, quarterly estimates, and it's going to be uh, March, April 15th, and it's going to be September, October 15th. So that's going to cover most of the things I need to worry about.
A lot of people just remember the April 15th one.
Yeah, yeah. And
That's the only one.
well, it makes a certain amount of sense because that's when everything gets finalized, right? Because
Right.
that's your 1040. So everything comes home at that point. But yeah, there's a bunch of stuff going on throughout the year.
Understood. So someone wants to know what are the tax difference of hiring independent contractors versus employees?
Yeah. So, what's the short answer? Uh, a contractor, you are just paying for, a contract service, and whatever you pay, that's it, right? So if somebody charges me $2,000 to clean my roof or whatever, I'm just paying $2,000. The end. Employee is a much more involved relationship, has a lot more filings required and a lot more expenses. So if I pay an employee $2,000, it's like, well, one, I have to withhold the employee side of taxes. I also have to pay employer taxes on that amount, which is going to be a higher. It's going to be additional on top of whatever the employee gets. And on top of that, there's going to be all kinds of like unemployment insurance requirements, the payroll filings that are due quarterly, and all this extra kind of stuff. So basically, you're going to end up paying 10 to 15% more than whatever the salary is for the employee for all those extra things. Plus, there's more administrative work to be done. So, if you want to build that in, that's going to be even more. Um, so if I pay a contractor 100 grand, it's just 100 grand. If I pay an employee 100 grand, it's going to be 100 plus, 10, 15,000 on top of that. So maybe 115,000. And that's why if you are dealing with a large company and you have a contract position, then you'll actually get paid more on an hourly basis than an employee because they build that in to make sure that, their cost of employment or cost of, uh, you know, service provision is the same. So it's much more involved when it comes to an employee versus contractor, and that's the basic difference. And how do you know you're one versus the other? Well, there's no like hard and fast rule, but there's a confluence of factors that they look at. That's basically how controlled are you in this employment. Like, do you have other clients? Do you set your own schedule? Do you use your own equipment? These kind of things are kind of differentiating factors between employee versus contractor. So if you do qualify to be a contractor, almost always, if you do it right, qualify that statement there. If you can qualify as a contractor and you do your setup correctly, it's going to be way more tax efficient because as an employee, they get you up front with Social Security, Medicare, and income tax. As a contractor, you have much more control over your destiny. So if you have the option, I generally recommend being a contractor. All right. So that does bring us to the end of today's session. We'll do it all again next week, which is going to be March 4th. Can't believe it. It's already March. So what are your next steps? Go join our Explorers group. Explorers, you can submit questions to this show. You can get access to lots of our courses and tools and things. So the most recent one I put up was the non-passive real estate investor, which will show you how to, if you have investment real estate, how to get the most out of it. And constantly adding stuff to the library there. So, and also you'll be notified of our workshops and all that kind of stuff. So check it out. It's free and worth doing. If you want to get to the next level, that's the navigators. And just as a reminder for all my navigator folks that are watching, on Thursday at 2 o'clock, we're having our profitability call for the month. That's going to be immediately before our usual weekly call. So keep that in mind. But if you're not either one of those, join up at the Explorers and you can keep up to date with all the stuff that we do. And with that, I'll see you guys later.